We have a new splash screen. You may have noticed it. And we are going to talk a little bit about equity market valuations and take a question that it seems like we missed, or at least according to the viewer we missed it, but we hadn't seen it before. I'm not sure where we missed it. Today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about the markets a little bit and then take your questions and try to illustrate how I like to look at things, and maybe you might want to as well. Before we get to that, so I put up a chart on my screen here. It's actually in Excel. It's the S&P price to book. So right now, the production staff is trying to figure out which of the many screens on my machine they're supposed to be sharing. But I've seen this concept brought up a couple of times in the past as people have talked a little bit about whether or not the markets are overvalued here. So what are some of the things that people like to look at? I've seen price to earnings. I've seen price to forward earnings, price to forward cash flow, and very recently, price to book. So this is a chart of price to book. I can actually make this a little bit larger, perhaps, and we can get an even better look at it. See if I can move this so that it's a little easier on the eye. And what we can see here, what we can't see, because I just did that. There we are. What we can see is that the price to book for the S&P 500 is now pretty much right about where it was back in March of 2000, which was, that marked the zenith of the tech bubble that started in the late 90s. The market rolled over. I think the S&P lost about half of its value, and the NASDAQ lost close to 80%. Now, the reason I wanted to show this is not because there's anything original about it. I've seen a lot of people circulating this. And I'll admit that when you look at something like this, it is not particularly reassuring. Good reasons for that. But I also want to make a different point, which is that, you know, price to book is a reasonable way to look at valuations for a consistent set of businesses through time. But one of the differences is that the most profitable businesses that we have now are very different than the biggest companies in the country were 10 years ago, 15, 20, 25 years ago in the case of the tech bubble, and before that. Older industrial types of business, we care considerably more about the value of the plant and the equipment and things like that. What are the value in the aggregate of all of the assets of a business? In the event that you dissolve that business and you are left with, you know, essentially what you needed to operate it. You can't really compare that type of evaluation to a business like Amazon. Amazon has considerable plant now, and they have a big logistics infrastructure, but it's only a portion of their business. Other big portions of their business that are assets, for example, the big server farms that make up AWS, you know, these are depreciating assets. It's really, they're services businesses. So software and services, we can't really value them quite the same way that we can a farm, for example. So I would say this is something we need to keep an eye on, like many things. If we looked at price to revenues, arguably that's a better measure. And there too, actually, I can probably pull this up. We can just take a quick peek. I happen to be looking at the VIX contango earlier today. So let's bring up price to sales here for just a moment. By the way, I'm not going to upgrade that right now. for those of you who have been watching this channel for a while and have seen me share screens, you're going to say, hey, this looks a little bit like what he used to share and not what he's been using more recently. And that is because this is a different terminal license, and I didn't upgrade it to the latest version because I kind of like the old version, and until I figure out the new one, I figured we will just use this. So if you look at it on a price to sales basis, you're going to see this is where we are right now. Not particularly reassuring either. And this too, though, gets somewhat influenced by these same dynamics, which is that older businesses tended not to have the kinds of margins that modern businesses do. And you know, one of the reasons that that's true is the same reason that the price to book is actually as high as it is. They don't have to have quite the same investment to generate the revenues that they do. So their margins tend to be much higher. And we can see that when we use something like the price to forward earnings, right? So I'm going to get rid of price to sales for a second. And now we can see that it's arguably elevated. We're going back to here. I'll just draw a line. So the white line is where we are right now. So now going all the way back to 1990. It is elevated, but it is not really quite near these peaks that we've seen. But it bears watching. We should pay some attention to these things to be sure. Okay, so having done that, let's move on to some questions that we had gotten that we apparently had not responded to. And I'm going to just move this over here so I can read it. Maybe we can bring up that first question. Yeah, so the first question was, I had this question unanswered last time. Now, this was the question that I apologize that we didn't answer it. To be honest, I didn't see this question. I think I probably would have remembered it if I had seen it because there's a lot going on with this question. In place of a stock in a covered call with short December strike in contango, okay, I'm a little curious about the contango piece. I'm using a short-term risk reversal in a non-IRA, keeping theta positive. What risk reversal adjustments are needed over time? Okay, so this is a really interesting topic, and I want to drop, I don't know if anybody happened to see this article. I wrote an article which was published on CNBC's website. In fact, actually, I'll probably bring that up right now because it has some charts in it which I think are going to be helpful for us and worthy of thinking about somewhat when we do this. You did not mention whether your risk reversal, whether it's all in one tenor, that is to say, all in one expiration. I asked that question because last May, and I think this is probably a good example for us to work through. I apologize if you're not seeing anything on my screen just yet because I have to find this article and then I'll bring it up. Last May, I believe it was on May 19th, I wrote an article about Target ahead of earnings. And in that article, I outlined that the stock obviously had been very badly beaten up and was trading at a big discount. And I'm not going to call it quite to comps because I don't know that Walmart is a comparable stock anymore. Walmart has a multi-channel distribution. They actually do more grocery sales than general merchandise at this point. So I'm not sure that Target and Walmart are really close comps, but I just pointed out that the spread in valuations was about as wide as we've seen it, meaning that Target, which many years ago used to trade at a premium in terms of multiples to Walmart, now trades at a very substantial discount. The company is going to be announcing earnings soon. So last quarter, ahead of earnings, I suggested a call spread risk reversal in Target. So this was back on, we'll call it May 19th, I think is when it got published. So I should probably, I'll go back to the 1st of May so we can get a sense of it. Okay, So this is how the stock has done since then. Stock is up marginally. I think we can actually calculate it. Why not? We'll just do a total return analysis since when I published that article. So that was on the 19th. Stock's up 7% or so in just a few months, and the total return, so that's net dividends, 8.25%. Not bad. Not bad. The options trade I suggested at the time was a call spread risk reversal with a little bit of a tweak. So that trade, I don't know if we're able to see this very well, that trade was buying the September 110 calls, bullish obviously, and then selling a June 84 115 strangle against it. So when we buy a call, then sell a higher strike call and sell a lower strike put, that's a call spread risk reversal. This is the same thing, but just spreading it out a little bit. And I wanted to own the Septembers because that would catch 2 earnings events. And I wanted to sell the Junes because options premiums were significantly elevated going into the print. And I thought a lot of the damage had been done and that the stock appeared to be making a bearish to bullish reversal. Those things still remain true today. But the point that I wanted to make is that if you have a structure like the one I recommended, it's important to modify that trade over time. And the reason is because when you sell options to make sure that you're collecting theta, eventually those options will decay so that there is insufficient extrinsic value remaining that the trade is positive theta. And it is at that point that you need to roll the short options. Now, if you're within 110er, you can roll the strikes in. So let's say I sold a 16 delta put and I sell a 16 delta call, and collectively they've lost 80% of their value. Well, 80% of the money that those things can generate for you as an investor has already been collected. So the risk-reward relationship of maintaining that position has diminished considerably. Now, in the case of this trade, what I did in this chart was I said, okay, the red trade is the set and forget. I bought a September call, I sold a June 27th strangle against it, and then I forgot I had the trade on, right? So that's the set and forget idea, that you don't manage your risk reversal at all. The blue line is if you do the trade management that I actually recommend, which is when the extrinsic value has lost about 80%, it's time to roll. So the first time to roll in this example would have been June 10th. The short strangle would have decayed to about 47 cents. Remember, we sold it for about $3, so it's lost more than 80% of its value at that point. What do you roll it to? Well, look out at 6 to 7 weeks and sell another 16 delta put and another 16 delta call. And in this example, that's what I did. Now you can see that there were maybe 2 trading days thereafter where you would have been worse off for having rolled it than just leaving it all alone. But those moments were brief and only just a little bit underperforming. Must have been some sort of kick up in vol or something like that. But sure enough, the positive theta provides a tailwind over time, and having rolled improves your performance. We can see that in the P&L of the trade in the blue line relative to the red line. Well, guess what? After another couple of weeks, sure enough, the new strangle, which was the July 22nd strangle, 16 delta strangle, if memory serves, that too had lost 80% of its value. What do? You buy it back, and you go out another 6 or 7 weeks from where you are right then, and you sell another one. Now, as it happened, that I think was the, trying to remember which one that was. It was maybe the regular SEPs. I have it written up somewhere else. But the important point is, once it's lost most of its value, in my case it was 80%, that's when I'm going to look to roll, out. Now, depending on the price of the underlying, using delta helps you determine what strikes you're going to choose. So somewhere between 16 and 20 delta for the calls or the puts is basically what you're targeting. Now, when I rolled this for the July to August roll, as it happens, target had appreciated a little bit. So remember the first time we sold the 84 puts and the 115 calls, and that particular expiration didn't have dollar strikes. So I had a choice, sell 85s or 90s basically. The 85s, if memory serves, were about a 13.5 delta, and the 90s were, I think, a 19 delta. So remember, I'm looking for a delta between 16 and 20. 19 delta is inside that range. The 13.5 was kind of outside of it. Also, remember that my underpinning thesis in the case of Target is mildly bullish, right? I'm saying that they're not out of the woods yet, but it does appear that they're kind of bottoming out here and making the turn. So I was completely comfortable at that point leaning a little bit longer delta. And it's not, we're really splitting hairs because the difference between selling a 16 delta put and a 19 delta put, it's not a huge difference. But lo and behold, you can see that then you continue to get that tailwind of theta helping you along. So you're maintaining your modestly bullish perspective, which a call spread risk reversal typically has, but you're keeping that theta in there, and that's a really important component. How important? Let's put some math to it. If you had put on the 84, 110, 115 September call spread risk reversal when I first wrote that article in May and done nothing, each spread would have netted you about $100 in profits. Your downside risk would have been that you get long the stock at 84 bucks, which was a significant discount to the current stock price at the time. So really, that's not a terrible rate of return when you consider that the risk was that you owned the stock at 84 when it was trading at 99 at the time that you initiated the trade. But compare that to just the two rolls. $500 a spread. That's not a little bit better. That's a lot better. And that's $500 again on first an $84 risk, but ultimately 90 because I rolled that put strike up. So just think about that for a second. So that's $500 on we'll call it 9,000. 90 times, there's 100 shares for every option. So, you're getting a 5.55% rate of return relative to risk of owning the stock relative to cash. So that's a pretty good risk-adjusted rate of return. So, from my perspective, because again, the risk of owning the stock at 90 is lower than the risk of owning the stock at 100 or 101 or now $104, right? So when you do that risk-adjusted analysis, you see that that's a pretty attractive rate of return. So I could have bought the stock, and my total return, if I had reinvested the dividends, would be about 7-8%. Or I could have done this options trade, which had a lower risk because the worst thing that happens to me is I own the stock at a 10% discount, and that's paid me about 5.6% over the same period of time. So almost as high a return, but lower risk. So this is what I hope this is kind of the answer to the question that you're looking for. And one other final point I would make is, you're saying, oh, well, gee, 5.5%, 5.6%. That's 5.6% since May 19th that we're talking about here, right? So, that's not 5.6% a year. We're talking about 5.6% in 3 months. You annualize that, you're looking at 24, 25% a year for taking slightly less than straight long equity risk. I think it's pretty good. But that's the thing you want to do. You want to, if you're going to short options, and all of these structures are generally going to be short options. You sold a call and a put, and you're long only one call. But think about this the same way if you're just doing covered calls, if you're doing risk reversals also, because a risk reversal can be positive theta if you sell a put that's at a higher value than the call you bought, but then as the stock goes higher, the theta goes negative. These are the little triggers you can use And depending on how much you want theta to be a component of the total return that you receive, and I think it's an important component because it's a kind of a tailwind, right? If the stock does nothing and you're collecting theta, you're getting paid to wait. And if you find yourself in a position where now you're long more premium than you're short, and if it's spread out in a calendar, you have flat to negative theta, it's probably time to roll. You know, I don't like the idea of being short options and paying to wait. That doesn't seem like a great solution. Okay, so that was that question. Next question, Ranjana Gupta. Could you please go over strangle swaps? Specifically, I have the following questions. Please confirm there are two types. One where you are short the short strangle, and one where you are long it. Oh yeah, okay. And when should each of the two types of strangle swaps be used? Okay, so let's talk about this a little bit. Let me just mock up two. You know, any options trade, there are two sides to it, right? I mean, that makes perfect sense. If you take one side of the trade, then presumably there's another side of the trade to be on. I could buy a stock, or I could short it. I can buy a call, or I can sell it. I can buy a put, I can sell it. Same thing, of course, goes for calendar trades. Most of the strangle swaps I've illustrated are trades where I'm long vega, that is to say I'm longer dated options, and long theta, that is to say I'm collecting premium over time because the options I'm short are decaying more rapidly than the ones I'm long, and I'm short gamma. So the long vega sounds good because you say, well, if volatility pops, I win. That sounds like a good thing. And long theta sounds good too. I'm getting paid to wait. And if it comes to trading a single option, you don't get both, right? If I buy a put option, if implied volatility rises, I win, but I have negative theta. So normally I'm expecting to lose over time. But I'm also long gamma. That is to say that I get shorter as the underlying falls and I get longer as it rises. Whenever you're coming up with spreads, you're squeezing the balloon, deciding what kinds of exposures you want more of, and which types of exposure you might like to have, you're willing to accept less of in exchange for the benefits that that alternative structure provides. In the case of a strangle swap where you are long the longer dated one, we're already talking about targets, so let's stay with it. And actually, let me just double check something here. Let's find out. I don't know if we looked at this, but I'm just going to pull it up on Unusual Whales because I'm just curious to see whether the implied move this time is much bigger or smaller than it has been in the past. I really think that these guys do the best job of illustrating this that I've seen. Okay, so here we go. And now we're looking at 18 quarters. This is the most recent one. Implied move, what Unusual Whales refers to as the expected move, 7.6%. We can see that last quarter, the expected move was 7.8. I'm rounding, and it actually realized 5.2. Previous one was 7.4, actually realized 3. And again, right now, 7.6. So, and if you go back in time, that's actually one of the bigger ones. Let's see if we can find a bigger expected move than the most recent ones. No. So over the course of the last several years, this is a bigger expected move. Now, considering how much damage has been done in Target, I'm maybe a little bit more comfortable being short the expected move here. I'm going to illustrate a trade that's not totally dissimilar to the calendar call spread risk reversal. Well, let's just do that first. Okay, so let's do a calendar call spread risk reversal where we're selling the near dated strangle, taking a mildly bullish view going into the print. So they're going to be announcing earnings soon. Let's just take a long, I think November, where are we now? Yeah, November should catch the next one. It's $105. So why don't we just choose, for this exercise, we're going to choose the at the money. Well, we'll go slightly out of the money. 47 delta is fine. So an almost 50 delta long call, November. And we'll choose let's go to the SEP 26s. We don't have exactly a 6 or a 7 week option to choose, but this should do fine for illustrative purposes. And we will sell, let's see. Well, I can choose 12 or I can choose 20. I'm going to choose a 20 delta call here. And on the put side, we'll choose something in the 16 to 20 range. And we've got a 16, 18, and a 20. Let's just choose the 16 deltas for now. Okay, so we get this structure here. All right, standstill positive rate of return, better than 50-50 chance probability of profit, benefits from the vol crush that takes place after the event, consistent with our thesis of a bearish to bullish reversal. Wish I had Carter Worth on to share his view of it, because he would probably tell me what was wrong with my layman's analysis of the technicals here, but that's kind of what it looks like to my eye. Okay, so in this case, now why am I starting? This is my transition to the strangle swap conversation, right? So what is similar about this to most of the strangle swaps that I have illustrated here before is that I am long two events, the upcoming earnings and the subsequent earnings, and I'm actually long a call that goes into, a traditionally relatively strong period. I've muted my immediate exposure to the underlying stock through the event because I'm collecting some premium, but also because I've sold an upside call, which mutes my upside participation. And my selling of a put gives me equity-like exposure, but only once and if the stock moves down to this, $93 level that I've selected here. Oh, I'm sorry, 92, which, just to put things in perspective, is a 12.5% discount to the stock's current stock price, right? Okay, so if I was going to look at this as a strangle swap, what is a strangle swap? How does it differ from this? Well, the strangle swap is going to have a vaguely similar characteristic. It's going to have less downside risk. In fact, a strangle swap can win if the underlying runs to the strike by the expiration of the near dated option. So let's just modify this trade and say, okay, in a strangle swap scenario, instead of buying the 110 calls, I'm actually going to buy the 120s. So let's look at this in pieces, okay? So now, what have I done? I've increased the probability of profit considerably. Why? Because I'm spending less premium. So the decay of that nearer dated strangle has improved things a decent bit. Okay. In fact, my net outlay is almost zero at this point. It's 75 cents, which is, essentially nothing. 75 cents a share. $75 on 100 lots is basically nothing. You might be able to get it off for nothing, depending on where the stock price is tomorrow. So almost a 70% probability of profit now. I still have the risk that the stock is going to be put to me at the short strike. But as I pointed out, that's a 12.5% discount. So not a bad trade. Not a bad trade at all. The strangle swap is less bullish than this. So I'm going to lay out more premium. And what I'm going to get for that is more participation to the downside. So now I'm going to buy a November 92 put. They may not have a 92 put strike, so I'll just pick the 90s. Now look what we have. Now you have this structure. So it still does benefit if the stock runs to the short strike, kind of like a buy right would. But I now have, $310 in additional outlay. Now, $310 of additional outlay is, I don't want to dismiss it, but that's $3.10 a share, right? So not really a huge deal, but, it's worth bringing it up. But what that does is it ends up taking away a lot of the standstill rate of return if nothing happens, the benefit that I was getting from the vol crush. Because where before I was short 2 options in the front and long 1, and I expect a little bit of vol to come out of the longer dated option, but a lot more to come out of the near dated ones. Now, because I have, 1 option for each, if it stays right here, it's, maybe I make some money, maybe I lose a little bit of money. It's probably not going to do a whole lot at spot. But I have the opportunity to profit if the stock runs to the short strike on the downside as well as the upside. So this is, as you can see, the profits are still better if it goes to the higher strike. So we can describe this as mildly bullish, but barely. I mean, again, look at this and then look at this. Pretty clear that this one is more bullish, and it has more of a standstill rate of return. So remember how I was talking about squeezing that balloon. Where have we squeezed the balloon? This looks better. Well, we're taking more risk in this region. If the stock goes to $80, because you're short the 92 put, in this structure, you're going to lose $12 a share if it goes to 80, basically, round numbers. Is that a big deal? Well, here's another way to think about it. If you lose $12 on a $105 stock, in the event that it moves to 80, that's an 11.4% loss of the current value of the share price. Whereas if you simply owned the stock, you're giving up 24%, right? So you basically are taking half the risk in this structure that you would if you simply bought the stock. And if you did a stock and did a buy right where you were selling an upside call, that would mute the downside a little bit. It would cut it down by however much you sold the upside call for. But, this is better. We'll say that. Or at least to my eye, I think it's a little bit better. And, the other thing is, take a look over here. We can kind of see where the stock bottomed out. Selling the 92 strike, we're right in this neighborhood here. This is the 9. Let's see if I can draw a line like this. Right? So you're taking the risk of being put the stock here. Okay? Which is, obviously it was chopping around a good bit. These candles illustrate that. But, that's really the risk you're taking. So, now this is something I have not illustrated, but I am going to address it really quickly. The question is, can you flip this arrangement around? Can you? Does one? Have I ever? Why and when would you do such a thing? And the short version is yes. And yes, in fact, one of the biggest options positions I had on early in my career was long gamma, but short Vega. It was in Philip Morris. This was sort of before Philip Morris became Philip Morris International, and there were all these different entities. But we're going back to the late 90s now. Early days for me as an options trader. And the big news at the time that was going on was that the tobacco industry was trying to reach a settlement with regulators essentially to deal with the liability associated with harm done to people who smoke. And there was this sense that an agreement was going to be reached at some point, that the whole industry was going to come to a conclusion. And I'm not going to claim that I'm the one that determined that the appropriate trade was to be short, long dated options and long gamma. But there is at least a thesis that supported it. So let's just talk about this. I'm going to illustrate it here in Target, although obviously this is not a trade recommendation. I want to make that point. But I'm going to use, since we're on Target already, why not? We'll illustrate it. In that case, I was actually short much longer dated options. They were leaps as it happens, but why don't we just pick pick, I'll go out to June. So I'll be short a couple June options. And we'll just say that I was, short an upside call. It's a little bit more complicated than this, but for our conversation, this will be more than sufficient just to sort of talk about it. And we'll say that I was long a straddle in the front. So I'm long, I'm got to flip this, I'm short this, I'm short that, I'm long this, I'm long this. And we'll make this the 105s. Okay. Now, why would anybody ever want to have a trade on that looks like this? Well, one argument could be or would be that we had an upcoming catalyst. We did not know when it was going to happen, only that it would, but probably soon. There was a lot of vol baked into the long-dated options because of this uncertainty. But once it came and went, that was basically going to be it. It could be a big number, it could be a small number. The industry could say we're going to settle for 100 billion or 2 or 300 billion. But whatever that number was, once you knew what it was, then the stock, in theory, should reset to some fundamental new value. When that happens, there would be a price jump. A great thing to own when there are price jumps is near-dated options because it blows right through strikes. You're not hedging this continuously. Remember what I've said more than once. If you're long options, you want the stock to blow through the strike. And if you're short options, you kind of would like it to run to the strike. So if the view was that you're going to get a big price move and then it's over, vol would come in, then being short Vega but long Gamma would make some sense. When else would a trade like that make sense? If you knew with certainty that a stock was going to be taken out, that was going to be purchased, it would be really handy for cash. So if it's bought for stock, that's a little bit different because then that stock converts into the newco stock or the acquiring company's stock, so it'll still have some vol. But if it gets acquired for cash, how much volatility does cash have? Nothing. You just get paid out. So wouldn't it be great to own short-dated at-the-money calls, leverage to the upside move, and short, long-dated calls at the strike where the stock was being taken out? Those things, the extrinsic value is going to go to zero. So that would be kind of the perfect trade, right? So whether you want to be, whether it's a strangle swap, whether it's something like a call spread or put spread risk reversal but spread across the calendar, whether you want to be long, longer dated options or short, shorter dated options depends on whether you think vol is going to be higher in the future or lower. In the tobacco settlement example I gave, or in the cash buyout example, vol comes in short, long dated. In the target trade example, own to catalyst, you got earnings this time, but I still have another earnings, and the near dated options are going to give that back, and I'm kind of I have a range of the expected move. Then maybe it's better to be long the calendar. Wow, that was a pretty chewy explanation, but I really hope it helped. I think we had another question in here. Let me see if. Okay, congrats on your new role. I would absolutely love for you to cover the difference between the YieldMax funds and NEOS funds. I own a bit of FBY, AMZY, and Winter, but overall have more invested in a number of NEOS funds, which I suspect have yields that are more sustainable. Thanks. So, there's a limited... First of all, we have some new products coming out, by the way. Salty comes out the day after tomorrow, is that right? One quick point, I'm happy to field questions on these products. That's actually part of my job and the strategy. I'm just going to throw it out there ahead of time. On anything that's about to come out, we will tend to have a quiet period. That's a regulatory thing, so I can't really get into it in great detail. But there is a broader issue that you're bringing up here that I think is kind of important. And that is that when you look at any product, any investment product, the thing that should matter most to you is the total return. So I happen to have on my screen right now, I don't know if we can see this. I have one of these products. This one is ALTI, which I think probably is a good place to get started. Now, if all you ever did was take a look at a price chart, this is the natural thing we typically do. You say, oh, you put the ticker in, and then you ask for a price chart, and you get something that looks like this. And you say, well, that doesn't look so great. I'm buying it, and it just goes down. Well, no. That's not what's going on at all. If you have a buy right, so there's a couple different dynamics, but you can see here that ALTI actually pays out distributions. And initially these distributions were monthly, but now they're weekly. Okay? The orange line actually reflects what an investment in this thing would actually give you. So this is 1 year, and 1 year invested in ALTI, and your total return, if you had reinvested the dividends in it, so let's say you compared it to SPY, right? SPY pays a nominal dividend, probably less than 2% right now. So if you bought ALTI and you just took all the distributions you got and bought ALTI again with those distributions, what would your total return be? And it would be 29%, which, not for nothing, is a lot better than you got in the market overall, right? 17.5%. So I'm doing, this is like for like. I take the dividends in SPY, I reinvest them in SPY, and after 1 year, I have 17.5% more money than I had when I started. I do that in ALTI, 29.31%, 2%. Almost 30% more than when I started. 30% is better than 17%. Full stop. I mean, I'm not telling you guys anything you don't know. Now, the tricky bit is that these are strategies that sell options. So let's just take a really simple example and imagine that you have a stock. We'll call it stock ABC. You sell calls against it. And whatever you sell those calls for, you take that money out. Well, if the stock goes up, some of your gains are limited because you sold that call. But if the stock goes down, then the value of those assets are going to go down. And if you take money out every single time you collect premium for the options, then of course the value of your account will have to go down by that amount. You haven't lost any money. If I have $100 in an account and I take $1 out of that account and put it in another account, well, now that account's worth 99 bucks, but I haven't lost anything. This obviously has a good total rate of return. I think we can all agree. Certainly if the S&P is going to be your benchmark, it beat that pretty handily, but that's not really the gist of the issue. It's the total returns that you want to concern yourself with. One thing that I hear people talk about is, if they see the price of the security going down and they say, can we reduce the distributions such that, the amount of money in that I hold in the security remains the same? Well, take some of the distributions and you can balance it yourself. To my eye, it's always better if an investor gets to make that choice. A common thing at publicly traded companies right now is companies repurchase their shares. They generate cash flow and they don't issue a dividend. They just buy back stock. And they say, we're returning cash to shareholders. Well, are they returning cash to shareholders? Yeah, they're not really returning cash to shareholders, but it has an accretive effect. It reduces the share count, right? So if an investor in a product like this that has big distributions is interested in maintaining stability for the capital base and deciding that they want to earn distributions on that same capital base rather than allocating that capital elsewhere, you can do that with those distributions if you should so choose. So the only thing I would say, and there's so many products out there, whether it's the Neos products that you reference or some other firms that do it, or the YieldMax products. I mean, there's a lot of YieldMax ETFs, as you know. We can pick apart each and every one. I mean, there are some that have a long bias, a short bias. There are single underlying ones. There's single underlying long, single underlying short. And all of these are intended to give investors additional flexibility. You, the investor, get to choose whether or not you're going to reinvest that distribution or deploy it elsewhere. You, the investor, get to choose whether you want to have more exposure to MicroStrategy or to Tesla, or whether you actually want to be short one of these rather than long, but still in a positive premium position. So that's really the issue that I would focus on if this is something that's of interest to you. Okay. All right, so let's take some of these. Finwest, did you paint your studio? It used to be white. You're the first person to mention it. NBC didn't mention it. Nobody has mentioned it. But yes, the studio used to be white. It is now Hail Navy. That's the color of the paint. It's called Hail Navy. But yes, it was indeed repainted. Do you like it? Should we repaint it white? I hope not. I kind of prefer this. And actually, you probably can't tell, but the television monitor thing that is behind me, the one that says YieldMax on it right now, that actually used to be, there's a bookshelf that it's a installed bookshelf on the wall over here, and the mount for that television used to be fastened to the side of that, and now it's actually hung down from the ceiling. Of course, you're not seeing the whole picture here, and nor would you want to, but yeah. So a couple of changes were made, but I hope that this was an improvement. But if it isn't, I don't know. I don't want to paint it red, even though that's a fortuitous color in China. In place of stock in a covered call with a short December strike in PC, actually I'm here. Oh, okay. That's why we may have missed the question. Okay, this is the same question. Okay, so oh, okay, okay, all right. You can hear me? All right. So yeah, there's something going on with the encoders. So we have a little bit of a backup. I'm probably bopping around here, but if you guys can still see me, we'll see. Okay. So, Bob, LYFT rallied 9% Friday. Co-founders leaving from board. Voting converted. Does this increase chance of LYFT getting acquired? Partnerships, acquisitions, stock buybacks, not doing so much for LYFT stock. So, yeah, for those of you who don't know, and this is, I think this is, we all are probably in agreement about this. I know why it happens. I actually talked about this last week. So what happened was LYFT had two share classes, the A and the B shares. The founders that Bob is referring to had Class B shares. Class B shares had super voting rights. So that is to say that if you own the Class B shares, your voting rights were greater than your proportional ownership of the underlying business would suggest that they would be otherwise. And this is, it's Mark Zuckerberg is in this situation at Meta, right? So he has super voting rights. Super voting rights are not that uncommon amongst founders and whether it's founding families and so on. And I completely understand how something like that happens. You found a company, you go public, and you still have a vision for how the business ought to operate, and all of a sudden you have people coming in with all kinds of schemes about how the business ought to go, and they kind of take control. So they get super voting rights, and that essentially creates some measure of protection for their ability to continue to run the business as they see fit. The downside to that can be that if the vision of the founders deviates considerably from what shareholders want, and you could have a considerable amount of shareholders. In the case of the two LYFT founders, I'm going to round up here because I think it's actually slightly less than 10%, but we'll call it 10%. So they represent 10% of the ownership of the business, but they had way more than that in terms of voting rights. Well, it's probably better from a shareholder's point of view in the general case that you get equal participation in terms of voting for your ownership interest. So I think that's a positive. And, you know, in Meta's case, don't forget that Mark Zuckerberg, he had this big thing about the metaverse. So they were making huge investments in that area. It was a massive spend. So we saw this huge CapEx going out, and it just wasn't translating to profits. And Meta got really beaten up a few years ago as a result of this. And eventually, Mark Zuckerberg said, okay, well, you know, this is obviously not working out. And he redirected. First, he cut the metaverse spending, and now he's kind of redirected towards AI. And that proved to be pivotal in terms of the share price. The thing had gotten absurdly cheap, but it got cheap because people were panicked about his direction and his outsized control. Namely, we don't like the direction of the business, but even though we own most of it, we can't do anything about it because Mark had all the voting rights. Now, Mark is a smart guy, and he wants Meta to be successful, and he changed his position, and I don't think I need to tell any of you how Meta has turned out since. In general, I think we would favor that there's just one share class. And I'm talking about one share class in the common, right? There can be different types of stock. So I want to make a distinction between saying, is there a Class A and a Class B share? Class B has super voting rights. That's different than if there is a Class A common and a preferred. Because a preferred is kind of a hybrid between equity and debt. So that's a different thing. You know, preferreds, convertible preferreds, stuff like that. I don't take any issue with that. You know, depending on the marketplace and the demand for certain security types and how they want to structure the, you know, basically build out the capital structure of the business, I actually prefer that flexibility. But yeah, I think this is definitely a positive. Does this increase the chance of LYFT getting acquired? Maybe a little. I think that if somebody came along and said, oh, I want to buy the company, and offered a material premium, maybe those founders, you know, could have been a little bit reluctant, and now it won't really matter if the board decides that they, and that's the other thing, they're stepping down from the board. So, you know, this is basically putting more of the control into the hands of general shareholders, general common shareholders, rather than the founders. And if their involvement day to day in the business is less than it was in the past, then I also think that makes sense, right? So, all good. Happy Monday. Yes, happy Monday to you. And yeah, and oh, one other thing I want to say about LYFT, and that is that, you know, we're looking at probably 9% forecast adjusted EPS growth year on year, and it's trading, I don't know where it is today. As of Friday, I think I saw it trading around 16 times. Let's take a look. How are we doing today? Everything was doing. That's basically unchanged. $1.40 a share. Yeah, look at this. $1.40 a share. Street estimates for next year. Wow, that's pretty good. 16 times, what was I talking about? That's 11 and a half. 11 and a half times forward. I must have been looking. Oh, I was looking at full year, obviously, because just over $1, 16 bucks. Really nice free cash flow yield too, and they have net cash balance. This is. These are let's discount all of this. We'll call it 800. You know, let's discount it even more. Let's say that they can generate 75% of what the street is looking for in next year's free cash flow numbers. That would be $600 million. Okay, $600 million on a $5.4 billion enterprise value. I mean, that's an 11% free cash flow yield. that's well, first of all, the company's got $1 billion in cash, in net cash, and maybe people are discounting that because they think the risk-free rate is going to decline, and that's where they're holding some of their cash, is in just interest-bearing accounts, and not inconsequential when you're dealing with that's 5% of free cash flow, right? It's $40 million on your free cash flow balance just if you're earning 5%. So something to think about. Okay. Hi, Mike. Now that UNH reported earnings, how would you re-rate their forward price to earnings? They estimated at least 16 in earnings per share for 2025. Historical price to earnings is 18 to 28 or so. It's currently trading at 19 for 2025. So, Steve, I set a buy rate for United Health. I think that was my final trade on Fast Money the last time I was on, which I believe was last Friday. I should remember exactly when I was on and was not, but lower end of the range. I think that's a positive. I think Steve Hemsley coming back to the helm is a positive. He's much more hands-on, greater familiarity with the space. The big build-out that they did in the Medicare and Medicaid space was probably a misstep. My biggest concern remains the investigation, right? Fraud investigations, nobody wants to see that. But other than all of those things, I think you're being reasonably compensated for the risks. I feel like we're starting to get some stability there, and I'm going to guess. Look, I don't know whether it was Buffett or somebody else over at Berkshire, but they're not pivoting into this one with no reason. So I do like that. Steve, hi Mike. Hello, Steve. PC risk reversal out about 45 days, all in one expiration. That's fine, right? And I like that, as if you're going to use one expiration for your risk reversals, your call spread or put spread riskies, I like that. You're getting a nice blend of theta with the short options that you have. And, the other thing is that there's not so much short gamma. These things can really get a little bit wobbly. Folks really like to try to harvest the short premium, and I get it, because if you sell an option that expires in a week, the decay is very high. But it gets a lot harder to manage those types of things because you have so much short gamma. So I like the expiration you're choosing. I was spreading one out by using an example of getting, call it a 100-day option on the long side and then short the 45s for the short strangle. But yeah, PC, I like what you're doing, like the way you're thinking about it, and I hope, by the way, that what I was talking about is helping to illustrate that. Monday morning quarterback, NVIDIA earnings 6 weeks. I have several collars versus stock. March 180, May 200, June 210s and 220s, and also short the Jan 170s. So you're outlining some of the calls that you're in. What puts are you in? So if you have it collared up, what puts are you using? Let's just pull up a chart of the stock first of all. See what we think of that. So you're short the Jan 170 calls, which are in the money at this point. That's yeah. Well, let's know. That'll probably be helpful to know which puts you have against that. Yeah, let's start with the last part first. If you are short the Jan 170 calls in your long stock, you're synthetically short the Jan 170 puts. For anybody who's listening to me right now and saying, what are you talking about? Let's just have a quick catch up on this most basic synthetic. Long stock short call is a short put. And we don't always think of a buy right or a covered call that way. But you definitely want to think about it that way if you are in something like this one where it's an in-the-money call. And let's illustrate this really quickly. So we're going to build this out. Here is the long stock. I'm going to add a short January 170 call. So here's January 170 call. We'll build this in. And I'm going to compare this. That's that trade. And now I'm going to go over here. And I'm going to say January 170 put. I'm going to be short that thing. Okay. Oops, did I do this right? Modify this. I must have done this. Long stock. Short call. Oh, there we are. Yep. Man, you'd think doing this as much as I do that I wouldn't have these kind of simple. Okay, there we go. That's all right. So long stock, short the 170 call. That's the risk reward relationship. Short 170 put. Very similar picture. So one way to think about it is if you have a long stock position and you bought a downside put and you're short an in the money call, what do you really have? You are short a out of the money put spread synthetically. All right, let's illustrate this. Let's say that you had the 160 puts as a long. Okay, so I put the 160 puts in here. That's what that trade is. Now, only thing I'm going to do is add the 160 puts to this one as well. So if you are able to do those kind of synthetics in your mind, that's what you end up with. So it's still a put spread, both of these trades. Now, if you're wondering why one looks a little bit different than the other, the reason for this is there's a carry cost component which the options trades are going to reflect. That is to say that if you had the put spread and you had the requisite cash, so imagine this. So you had the amount of cash required to put up the stock, 100 shares at $182 a share, so $18,200. $18,200 with 151 days to go, with a risk-free rate of about 4% interest. So we'll just call it half a year, right? So that's 2% of 18,000. So you would earn that interest. That's not being reflected in the P&L here, so it's not like there's an arbitrage. Just want to make that point in case anybody's looking there saying, oh, well, I want to buy this and sell that because there's found money. No, there isn't. Because the long stock you're going to be posting, and when you post that stock, then you're giving up the interest, the risk-free interest that you would have received on the cash balance. So that's the reason. If you're looking at this and you're saying this one's a little bit taller than this one, that's the reason why. So there's no arbitrage. Wish there was. But yeah, that's effectively the structure that you have there, and that's fine. I rather like it. I'm certainly not short NVIDIA here, but I've said this more than once. Coming into September, I just feel like it's a choppy month. We've got a little bit of risk around FOMC. People were luckily, some of that risk has actually been diminished because with last week's inflation data, the expectations for a cut, I think, have gone down. We had like a 90% probability, and some people were saying, oh, it's going to be 50 basis point cut or bigger. That's come in a little bit. So as a risk factor to equities, it's come down a bit. But it's still a choppy month historically. Max Convexity, hello from Austin, one of my favorite cities, and I lived there for 5 years, so I know whereof I speak. What is the weather like in Austin right now? It's probably a little hotter than it is by the bay over here. Michael Walter, what do you mean by the standstill rate? Excellent question. Standstill rate of return. The standstill rate of return, when we're talking about an options trade, and we were talking about target at the time, is the money that you would expect to make just as time passes if the stock does nothing. Okay, so a simple way to illustrate this, I'll just come up with a short put. So I'll put a put in here. Oops, nope. That's not what I do. Very simple trade. cash covered put, standstill rate of return. That's the money I'm going to make if the stock doesn't move between now and expiration. In this case, it's $4.25 a share. $4.25 a share versus, you could think about this two ways. You could say, I want to look at this versus the current stock price. So that works out to 4%, round numbers, or I could think about it relative to the strike price of 100, 4.25% in that case. And then I'm going to be collecting that over 60 days. So there's three. Now, I know in finance, people often use 360, when they're doing interest rate calculations, which, as it happens, is pretty handy here, because then you just multiply that standstill rate of return by 6 to get your annualized standstill rate of return. So if I'm getting 4% annualized, if over 60 days annualized, I could say multiply that by 6 gets me to 24%. So that's how much I'm collecting relative to the current value of the strike, 105. Or I could multiply 4.25% by 6. Kind of splitting hairs, gets me to 25.5%. Again, now that's relative to the strike, which is a good way to think about it, because that's truly your risk, right? It's not 105 isn't your risk. It's the risk is the strike price, where you would be put the stock. And you could even say, well, maybe it's that less the premium you collect, which is the effective purchase price of the stock, which is $96. But that's what I mean by standstill rate of return. It's how much you will make if you put an options trade on and you hold it until expiration and nothing happens to the underlying. And a standstill rate doesn't have to be a positive number, because if I buy this put, it has now become negative. Because if I buy this put and the stock doesn't go down, I'm going to lose my premium if I do nothing. So that's a negative standstill rate of return. Right? 100 degrees today in Austin. That sounds about right. It's that time of year. Alex V. Oh, I'm being warned by the crack production staff that we've actually gone over the hour. So PC happened to Steve Jobs, who founded Apple, got kicked out, SEP of 85. Yes, but he came back. Monday morning quarterback, just as a follow-up, 150, 130 put spreads, mostly those and several others. Oh, I like that. I like the fact that you're using put spread collars instead. So yes, all good. Can NVIDIA advance even more on earnings? Yes, I think it can. Is it more probable to see some kind of a correction? If I knew the answer to those kinds of questions, if I had a crystal ball, I'd be happy to share it with you guys. I probably would be possessed by looking at my crystal ball all the time to see what was going to happen next. I wish I knew. I do know that the company is just killing it. They're knocking it out of the park, and the build out has not slowed at this point. Interesting, by the way, something you guys might want to pay attention to. We saw that some Democrats in the Senate are a little bit concerned and expressing that concern to the administration about the sale of advanced chips to places like China, which is kind of interesting, because I kind of feel like it felt like the same group of people were criticizing the administration's efforts to restrict some of those sales, and now that they've been relaxed, it seems like they're going the other way. But maybe that's just politics. Who knows? Could the rally resume? I'm going to say resume, because actually NVIDIA is kind of leveled off here. You guys have probably noticed that. Hasn't really been hitting all-time new highs day after day after day. Could it go higher? Yes. Will it? I don't know. Operationally, I think the company is still crushing it, though. It's kind of a non-answer. I wish I had something better for you, but I hope that helps. And I want to thank all of you guys for tuning in. If you love or hate the paint behind me, let me know. Hopefully you love it, and then I can, because it was actually my wife who said she thought it looked terrible the way it was, and she really likes it. By the way, Hail Navy is kind of a blue color. It looks gray. When I look at the picture, when I look at the return, it looks gray, but it's actually kind of a bluish color. I rather like it. Let me know what you think. And be sure to like, subscribe, notification bell, tell your friends. and tune in for the next one, which we're going to be doing on Wednesday. Same time, same channel. Hope to see you then. Thanks for watching.